BHP Billiton closes the door on a tumultuous earnings season for miners. 88% have missed expectations, profits across the board down by almost half. No wonder then that mining shares are underperforming today. I'm Jamie McGeever and this is Market Pulse. So, is there any good news to lift the sector? Well, let's find out from Josh Raymond. He's market strategist at City Index. Josh, let's start with BHP Billiton. 35% fall in Q2 profits, shares down almost 2%. How low can the stock go, especially given the light volumes?
It is light volumes. That's a good thing to mention there, because obviously light volumes can exacerbate some of the moves as well and clouds a bit of the true sentiment around there. The one thing I would say is that the results from BHP weren't actually terrible. I mean, they're pretty much slightly actually better than expected. The 35% drop in profits, the market was looking a little bit lower than that, around the 7 billion mark. So the actual figure was 7.16 billion. So that was slightly better than expected, but it is tracking the general sector a bit lower. From a pricing perspective, I mean, it has been in that last year, pretty much August last year to August this year, it's been within that sort of trading range. If it does continue to fall off, you'd be looking at support around the 1800 level.
1800. Of course, before that, we've got the 200-day moving average around 1920. Do you expect to see the stock attract some buyers there?
Yeah, potentially. I mean, you always look at movements around sort of the big MA levels. The one thing I would say is that if you look at broadly as the mining sector in general, the FTSE 350 mining sector as a whole, it's actually on near-term support levels as it is. So, you know, that could also help BHP to move slightly higher. But again, if we do break below 1920, I think you'd be looking at maybe 1800 as the next significant support level. A break below that, then you'd be looking at longer-term support levels.
And of course, we mustn't forget that the stock has had quite a good run in the last few weeks, about 10% in the last month. Let's move over to Lonmin. Of course, the appalling events in South Africa over the last couple of weeks, the share price has dived around 20%. Is that decline overdone, or are we looking at taking out the late 2008 low, which would take us back to, I think, 1999?
I don't think it's overdone, purely because investors hate uncertainty. You've seen with Standard Chartered, for instance, when the Iranian scandal hit, their stock absolutely tanked, obviously, and it recovered because some of the certainty was put back into the market price. And with Lonmin, because obviously you're looking at production levels, no one knows really what the material impact on the output, particularly for that region, for South Africa, obviously is going to be. People are talking around single-digit percentages compared to a year before. I mean, that's a huge drop, obviously. So it's the uncertainty levels that's triggering this. And also, we're now hearing about potential right issues as well. They've got a debt ratio of a debt level of $356 million. From that perspective, if the market continues to come off and they can't get their output up and therefore their earnings going to be hit, then we're looking at potential rights issue, and then you would be looking at those lows again.
OK, now obviously, as we all know, the mining sector accounts for around 10% of the FTSE weighting. Given the bleak outlook for the sector, slowing growth and Chinese demand, etc., is the FTSE destined to underperform its peers such as the German DAX?
I'm actually more comfortable about that, to be perfectly honest with you. I think it gives you a bit more realistic. I mean, you look at the DAX, for instance, trading towards its sort of 4 or 5 month highs. You look at the Dow 4-month highs. S&P broke a 4-year high last night, for instance, and then we saw it sell off from a technical perspective. So it actually makes me a little bit more comfortable with the way the FTSE is, because I still don't think we're fundamentally as strong as some of the broader indices are. The one thing I would say with the miners and the impact on the FTSE 100, there are two key catalysts to look at. One is Chinese stimulus. We are still waiting to see whether there'll be more rate cuts to come. China doesn't hold back, and they're looking to speed growth in the second half of the year. So that could be a beneficial support for the miners. And the other thing, obviously, is QE, whether we start to see more movement from the Fed. You look towards the FOMC minutes later on tonight, and also a move towards Jackson Hole later on this month. OK, Josh, great stuff. Thank you very much. My thanks there to Josh Raymond from City Index. That's all for now, but watch us at this time every weekday for Market Pulse, a look at what's moving on financial markets and why. I'm Jamie McGeever. This is Reuters.